Support levels are crucial price points in technical analysis that indicate a potential halt or reversal in a stock's declining price. Essentially, support levels act like a floor, representing a price at which buyers consistently step in and purchase enough shares to stop further price decreases. Traders and investors identify support levels by examining historical price data, looking for patterns or price points where the stock's price repeatedly stopped falling and began to rise again. These levels are significant because they often represent psychological price points where market participants believe the stock is undervalued or fairly priced. There are several key tools and indicators traders use to identify support levels. 1. Historical price lows. One of the simplest and most common methods of identifying support is by looking at past price lows. If a stock has repeatedly reversed upward from the same price level, it strongly indicates that this is a significant support level. For example, if stock XYZ consistently reverses upwards whenever it touches $50, traders mark $50 as a critical support level. 1. Trend lines. Another effective way to identify support levels is by drawing trend lines. An upward sloping trend line is drawn by connecting a series of ascending lows, forming a visual representation of support. As long as prices stay above this trend line, the overall trend is considered bullish or positive. 1. Pivot points. Pivot points are mathematical calculations based on the previous day's price action, high, low, and close. They provide traders with potential intraday or short-term support and resistance levels. Pivot points are especially popular among day traders who look to identify entry and exit points quickly. 1. Fibonacci retracement levels. Fibonacci retracement levels mean using specific percentage points derived from the Fibonacci sequence to identify potential levels where a stock might reverse direction during a price correction. These levels, 23.6%, 38.2%, 50%, 61.8%, and 78.6%, represent likely areas where buying interest could resume. Traders apply these tools and indicators to identify potential support levels, helping them make informed decisions in their trading strategies. For practical application, let's examine a scenario with stock ABC. Suppose the price consistently finds support around $30. This repeated behavior indicates strong buying interest at that level, likely driven by traders and investors' perception of value. If ABC approaches $30 and volume increases significantly, it further reinforces this support level's validity. In this example, traders who believe in the stock's long-term prospects might enter buy orders near the $30 level, anticipating a bounce upward. Conversely, if the price were to decisively break below $30, traders would interpret this as a breakdown, signaling a potential continuation of the downward trend and possibly triggering sell or short sell orders. Clearly, annotated visual charts enhance the identification and comprehension of support levels. Visual representations help traders quickly recognize patterns and validate their analysis across various scenarios. In summary, accurately identifying and understanding support levels can significantly enhance your trading strategy by providing clear guidelines for entry and exit points, minimizing risk, and optimizing potential profits. Resistance levels are critical price points in technical analysis, representing price levels where selling pressure becomes strong enough to halt further price increases. Essentially, resistance acts as a ceiling, stopping the stock price from rising further as sellers begin to outnumber buyers. Traders and investors identify resistance levels by analyzing historical price data, looking for consistent price points where the stock's upward momentum repeatedly stalls or reverses downward. These resistance points often represent psychological levels where the market believes the stock price is overvalued or fairly valued. At resistance levels, selling pressure intensifies as more traders decide to sell their positions, believing the price won't go higher. At resistance, a battle between buyers and sellers occurs. Buyers become hesitant while sellers grow more confident. Resistance levels often act as psychological barriers, influencing traders' decisions based on past price behavior and market sentiment. When price breaks above resistance, it often signals a shift in market dynamics, potentially leading to further upward movement. Understanding resistance levels is crucial for identifying potential reversal points, managing risk, and making informed trading decisions. Key tools and indicators traders commonly use to pinpoint resistance levels include 1. Historical price highs. One straightforward method for identifying resistance is observing previous price highs. If a stock frequently peaks at the same price level before declining, traders mark this as a notable resistance level. For instance, if stock DEF repeatedly encounters selling pressure around $80 and subsequently declines, $80 is established as a significant resistance level. 1. Trend lines. Resistance levels can also be effectively identified by drawing trend lines. A downward sloping trend line connecting consecutive descending peaks visually illustrates resistance. Prices remaining below this trend line suggest a bearish or negative market sentiment. 1. Pivot points. Pivot points, calculated based on the previous day's high, low, and close, serve as valuable short-term or intraday resistance levels. Traders frequently use pivot points to quickly determine potential exit or short-selling opportunities during trading sessions. 1. Fibonacci extension levels. Fibonacci extension levels mean using calculated percentages based on the Fibonacci sequence, commonly 127.2%, 161.8%, and 261.8% to project potential price targets or resistance areas. Traders apply these extensions to forecast possible price peaks after significant upward movements. Practical scenarios provide clarity in understanding resistance levels. Let's consider stock GHI as an example. Suppose the price repeatedly encounters resistance at the $90 level. This consistent pattern signals significant selling interest at that price point. Traders monitoring stock GHI may observe rising selling volume as the price nears $90, reinforcing this resistance level's validity and indicating increased bearish sentiment. In this scenario, traders may set sell orders or short sell positions as stock GHI approaches the $90 level, anticipating a price decline. Conversely, if the price decisively breaks above $90 with increased buying volume, traders interpret this as a breakout, a bullish signal indicating potential continuation of the upward trend and possibly prompting additional buying activity. Clearly, annotated visual charts significantly aid in identifying and interpreting resistance levels, providing visual confirmation of market behavior and assisting traders in validating their analysis. Accurately identifying and comprehending resistance levels enables traders to make informed decisions, strategically planning entry and exit points, effectively managing risks, and optimizing trading outcomes. Understanding the concepts of support and resistance is essential, but applying these principles effectively in real trading scenarios is critical for success. Practical application involves carefully monitoring price movements, volume indicators, and other technical signals to make informed trading decisions. Breakouts occur when a stock price moves above an established resistance level with significant volume, suggesting strong buyer interest and potential continuation of upward momentum. Traders often interpret breakouts as bullish signals and consider entering long positions. Conversely, a breakdown happens when a stock price falls below an established support level, typically accompanied by substantial selling volume. Breakdowns indicate bearish sentiment and potential further price declines. Volume plays a crucial role in validating breakouts and breakdowns. High volume during these price movements reinforces their reliability, signaling strong market participation. Conversely, low volume may indicate weak momentum, causing traders to approach these signals cautiously. Combining support and resistance analysis with moving averages, such as the 50-day simple moving average or 20-day exponential moving average, provides additional context about overall market trends. For example, if a stock breaks above resistance while simultaneously trading above a key moving average, traders gain confidence in the bullish breakout. The relative strength index is a momentum oscillator indicating overbought or oversold conditions. If a breakout coincides with the RSI moving above the neutral 50 level, it strengthens the bullish signal. Conversely, a breakdown accompanied by RSI dropping below 50 enhances the bearish outlook. MACD is a momentum indicator providing insights into potential momentum shifts. A bullish MACD crossover occurring alongside a breakout further validates upward momentum, whereas a bearish MACD crossover alongside a breakdown confirms negative sentiment. Consider stock PQR, which historically trades between support at $100 and resistance at $130. Traders carefully monitor this range. If stock PQR approaches support at $100 and volume increases significantly with bullish indicators such as a positive MACD crossover and RSI rising above 30 from oversold conditions, traders might enter long positions, anticipating a bounce upwards. Conversely, if PQR nears resistance at $130 with elevated selling volume, bearish MACD crossover, and RSI falling below 70 from overbought territory, traders might initiate short positions or sell holdings, expecting a price decline. Visual charts clearly depicting these scenarios assist traders in recognizing and interpreting these patterns accurately, enhancing decision-making confidence, effectively applying support and resistance analysis with additional indicators. And volume confirmation empowers traders to craft robust strategies, improving accuracy, minimizing risks, and optimizing potential profits. Moving averages are among the most widely used tools in technical analysis, essential for smoothing out price data to identify clear trends and potential trading opportunities. By filtering short-term price fluctuations, moving averages help traders gain a clearer view of market direction and momentum. Types of moving averages. 1. Simple moving average, SMA. The simple moving average is calculated by taking the arithmetic mean of closing prices over a specified number of days. Common SMA periods include 20, 50, 100, and 200 days. The SMA provides a straightforward indication of a stock's overall price trend, making it particularly useful for identifying longer-term trends and potential support or resistance levels. 1. Exponential moving average, EMA. The exponential moving average assigns greater weight to more recent price data, making it more responsive to recent price movements compared to the SMA. This responsiveness allows the EMA to identify potential changes in trend direction more quickly, making it especially useful for short-term trading strategies. Optimal settings for different trading styles. Short-term, day trading. Day traders often utilize shorter period EMAs such as 5, 8, and 13-day EMAs, which rapidly respond to intraday price movements. These short-term EMAs help traders identify quick entry and exit points within the same trading day. Medium-term, swing trading. Swing traders frequently use intermediate period SMAs and EMAs, such as the 20-day EMA or 50-day SMA, to capture meaningful price swings that occur over several days or weeks. These averages provide clearer signals for potential trend reversals and sustained movements. Long-term investing. Investors typically focus on longer-term SMAs, such as the 100-day or 200-day SMA, to assess broader market trends and significant support and resistance levels. These long-term averages are particularly valuable in identifying major market trends and long-term investment opportunities. Moving average crossovers. One of the most powerful trading signals generated by moving averages is the crossover, bullish crossover. A bullish crossover occurs when a shorter-term moving average crosses above a longer-term moving average, signaling potential upward momentum. Bearish crossover. Conversely, a bearish crossover occurs when a shorter-term moving average crosses below a longer-term moving average, signaling potential downward momentum. For example, when the 20-day EMA crosses above the 50-day SMA, traders interpret this as a bullish signal, indicating possible price increases ahead. For instance, if the 20-day EMA crosses above the 50-day SMA, traders see this as a bullish indicator, suggesting further price increases. Conversely, if the 20-day EMA crosses below the 50-day SMA, traders interpret this as a bearish signal, suggesting possible price declines. Practical example. Consider stock STU, currently trading at $45. The 20-day EMA recently crossed above the 50-day SMA, signaling a bullish crossover. Traders observing this crossover might enter long positions, anticipating continued upward price momentum. Conversely, if the 20-day EMA later crosses below the 50-day SMA, traders might interpret this as a bearish crossover and exit positions or initiate short trades. Moving averages as dynamic support and resistance. Moving averages also frequently act as dynamic support or resistance levels. In an uptrend, the stock price often finds support at the moving average, bouncing off it and continuing upward. During a downtrend, the moving average tends to serve as resistance, preventing prices from rising above it and indicating potential continuation of the downward trend. Enhancing reliability with additional indicators. Before discussing how to combine moving averages with additional indicators, let's define the key tools involved. Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is primarily used to identify overbought, above 70, or oversold, below 30 conditions in the market. Moving Average Convergence Divergence, MACD, is a trend-following momentum indicator that shows the relationship between two EMAs, typically the 12-day and 26-day EMAs. It helps traders identify changes in momentum, direction, and potential reversals. Volume analysis involves examining the number of shares traded during a specific period. It helps confirm the strength of a price move. Higher volume during a breakout or breakdown strengthens the signal, while lower volume weakens it. Combining moving averages with these indicators significantly enhances trading accuracy. These tools provide complementary insights that validate trading signals derived from moving averages. RSI helps traders identify overbought or oversold market conditions, confirming the strength of moving average signals. MACD indicates momentum shifts, providing additional confirmation of trend changes suggested by moving average crossovers. Volume analysis reinforces the validity of price movements associated with moving average signals. Higher volume strengthens the reliability of signals, while lower volume warrants caution. In conclusion, mastering moving averages and integrating them with additional technical indicators allows traders to make more informed, strategic decisions, improving trade reliability, minimizing risks, and enhancing overall profitability. Advanced integration of concepts. Effectively integrating support, resistance, moving averages, and additional technical indicators into a cohesive trading strategy is paramount for consistent trading success. Step 1. Identifying key levels. Begin by meticulously identifying significant support and resistance levels. Historical price analysis, pivot points, trend lines, and Fibonacci retracement and extension levels provide foundational data points. Step 2. Confirming trend direction with moving averages. After establishing key support and resistance levels, incorporate moving averages to confirm the prevailing trend direction. Analyze short-term and long-term moving averages to gain insights into market momentum and trend stability. Step 3. Validating signals with additional indicators. First, the RSI. Confirm overbought or oversold conditions to assess the sustainability of price movements. For example, if a bullish breakout occurs, and RSI simultaneously moves above the neutral 50 line or out of oversold territory, this strengthens the bullish signal. Next, the MACD. Utilize MACD to identify shifts in momentum. A MACD crossover aligning with a support or resistance breakout enhances signal reliability, providing greater confidence in market entries or exits. Lastly, volume analysis. Validate price movements with corresponding volume changes. Increased volume during a breakout or breakdown significantly strengthens the reliability of the signal, while low volume might suggest caution and potential false signals. By integrating these concepts strategically, we can provide robust and actionable insights, significantly improving trading outcomes. Notice how the alignment of multiple indicators strengthens our trading signals and helps identify high-probability trade opportunities. Remember, combining these concepts strategically is key to developing a robust and effective trading strategy, leading to more consistent and successful trading outcomes. Real-world trading scenario. Example. Let's examine a hypothetical scenario involving stock VWX. Step 1. Identifying levels. After careful historical analysis, traders identify strong support at $60 and resistance at $80. Step 2. Trend confirmation. Currently, the stock is trading above its 50-day EMA and 200-day SMA, indicating a bullish market sentiment. Recent price movements show the stock consistently bouncing off the $60 support level, further confirming bullish behavior. Step 3. Signal validation. At the most recent test of the $60 support level, the RSI rose sharply from oversold territory, MACD demonstrated a bullish crossover, and trading volume increased significantly. These combined indicators provide strong confirmation of bullish momentum. In this scenario, traders might confidently initiate long positions near the $60 support level, anticipating a move towards the $80 resistance. A clearly defined risk management strategy, including stop-loss orders slightly below the support level, helps manage potential downside risks. Managing risk effectively. Integrating these technical analysis concepts into your trading plan significantly improves decision-making and risk management. Effective risk management practices include setting stop-loss orders. Position stop-loss orders just below support levels for long trades or just above resistance levels for short trades to limit potential losses. Determining risk-to-reward ratios. Always assess potential trades for favorable risk-to-reward ratios, typically aiming for a ratio of at least 1. 2, meaning potential profits are twice the potential losses. Position sizing. Adjust trade sizes based on risk tolerance, support and resistance proximity, and overall market volatility. Smaller positions are advisable during periods of increased uncertainty or volatility. Continuous learning and adaptation. Market conditions continuously evolve, necessitating ongoing learning, analysis, and adaptation. Regularly review your trading strategies, analyze trading outcomes, and refine your approach based on observed results and changing market conditions. Journaling trades and systematically reviewing performance can highlight areas for improvement and reinforce successful practices. Conclusion. Advanced integration of support, resistance, moving averages, and supplementary technical indicators forms a comprehensive, robust trading strategy. Implementing this integrative approach enhances decision-making precision, minimizes risk, and maximizes potential profits. Like, subscribe and share for more insightful trading strategies and tips. Disclaimer: the information provided in this video is for educational purposes only and does not constitute financial advice. Always perform your own research or consult a professional advisor before making any trading or investment decisions.